Welcome back. Get ready for a melt-up rally. That is what our next guest is calling for in the months ahead. He is Tom Lee. He is Fundstrat's co-founder and the head of research, also a CNBC contributor. And as you see, he's here at Post 9. Nice to have you.
Great to see you,
Just
Scott.
saw Dietrich on. He's bullish. And you are too, but you say too many people are not.
Yeah, you'd think that with the S&P doing well this week and a great May, investors are bullish. They are not. In our calls and Zooms with portfolio managers, many are still cautious because they see tariff risks ahead and they don't have tariff resolution in hand and they can't get bullish. I think the feedback we get from a lot of folks is they think stocks shouldn't be rising. So I would say, given the amount of cash on the sidelines, the fact that short interest is going up, and we have a quiet week and markets are rallying, I think the risk is now of a substantial leg up rally from here.
What role do tariffs play in all of the way you're thinking about the market?
Well, tariffs matter. Remember, before February, before Trump sort of talked about this, the base case for many was a 15% tariff. Let's say that we're going to end up at a 10%. That's 10% on 15%, which is imports, which is about a 1% GDP effect. That's not that different than oil going from 40 to 80, and we wouldn't say $80 oil breaks the economy anymore. So I think tariffs aren't, we have to adjust to it, but it's not the thing that takes us to 4,000 S&P anymore.
Now, what if there's a renewed and more protracted, if not dug-in fight over the tax bill? What if Musk's post on social media earlier is enough to get some lawmakers in a very thin margin Washington to rethink their positions based on his political donations or lack of support in the future? Is that a real concern in any way?
Well, this is what's going to be set up as what I'd call event risk. And it's an event risk similar to a government shutdown or an auto plant shutdown, something that affects the economy for a specific period of time. But again, those have not been things to turn structurally bearish. They may be tactical risks, but again, they've always been buy the dip opportunities.
So if, for argument's sake, the tax bill ends up not as big as the price tag is on it now, would that be a positive taken by the market? Maybe the bond market would feel pretty good about that, wouldn't it?
Yeah, I mean, Scott, it's kind of hard to say because I could see it being if bonds rally, that's good for equities. But if this tax bill leads to more spending, even if yields rise, markets are going to focus on the earnings effect. So I'm just going to say it could go either way. I mean, it could be bad or it could be good.
When you hear Jamie Dimon talk about there will be cracks in the bond market, do you just brush that off as that, I would expect someone in Jamie's position to be talking about the risks that are in the system? Or do you sit back and say, well, maybe that first little scream from the bond market was before there's a full-on tantrum, which wouldn't be good for equities in any way?
Well, JP Morgan has a dashboard to the U.S. economy because they see consumer credit. They see it real time. We know consumer credit delinquencies are rising and auto loan delinquencies are rising. But is that going to spill over into the broader credit market to create a credit event? The one market we watch is high yield. High yield spreads have actually managed to hold on to most of the rally gains, and they've retraced 70% of the widening. That's a market that says the economy actually is starting to strengthen.
So you don't put that much cred into bigger worries about the bond market having an issue anytime soon. And even for accuracy's sake, I mean, it's not like he said we're going to have this issue tomorrow. I don't know if it's 6 weeks, 6 months, 6 years. I'm paraphrasing, but that's generally what he said.
Yeah, I mean, I think Jamie's flagging that there are parts of the economy that are weak, including housing. I mean, housing is deteriorating very quickly, but that's also going to deliver a pretty big deflationary pulse. That was 75% of the rise in inflation since 2019 is housing and auto services. So if housing is turning down on price because there's supply, I would argue that's a structural decline in inflation. The Fed would actually have to be quite dovish in the next 12 months. That's bullish.